Get out now. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, a major investment firm is freezing redemptions again as investors are desperate to get out. I'll show you why they want out and why the firm doesn't. Plus, if you're wondering what we're doing at the ports again today, it's because we're seeing renewed signs that global demand is coming crashing down at a time when central bankers still think higher for longer. We're saying not much higher, and they're going to be going lower for a lot longer than they think. And we have a sponsor for today's show. MyMD is developing groundbreaking therapies to fight chronic disease. You can find them on the NASDAQ under the symbol MYMD. And with all our sponsors, we love to show you how to trade their stock, and you're not going to believe this because there's a setup as they're coming out of a supply zone. Momentum's building, and we think a stock could move as much as 100% to the upside. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up because we're looking for signs that the global economy is running out of money, and one place it looks to be is China, as stocks in Hong Kong dropped the most since July as market reopens. Equities listed in Hong Kong are linked to more closely to foreign fund flows. As we've made the case, investors want out of China in a big way than onshore China shares, making them typically more vulnerable to global events. A measure of Asian shares was on track for its lowest close since November after hawkish signaling from the Federal Reserve intensified a sell-off in treasuries and boosted the dollar. Of course, we know where this money's all going. It's flowing into U.S. equities. And if you ever wondered why you typically see a peak in U.S. equities and then a second peak or a near-term peak, is because all of a sudden everyone looks to the U.S. and says, hey, their economy is doing better than the rest of the world, and that's because we see the last of it. And so money flows in, and next thing you know, the money around the world dries up and stocks come crashing down. And so that's the kind of recurring theme here today. We're looking for money, and we're not finding it. As Europe's November gas contract plummets, here we see these words again, demand collapses. Granted, there's some weather-related reasons, but look at this. In Germany, commercial and residential demand last month was almost half. So that's not just a slight decrease, half what it was a year ago, adding that a small amount of industrial demand growth from August has totally evaporated. So we've been talking about how in Germany, their manufacturing sector is in a depression. We're looking at depression level data. There's the evidence. Energy demand way down. It's outright evaporated. So again, we start again looking around the world. We're looking for money that's being created to create economic growth, and we've been making the case that all these inverted yield curves and inverted money curves are causing the opposite to happen, and yet the evidence is further mounting, and it's even now starting to show up on U.S. shores. As Port of New York and New Jersey, cargo volumes dropped by a whopping 21% in August, as cargo volumes at the Port of New York and New Jersey fell 21% year over year in August as the seaport adjusts to lower retail volumes. And boy, that's a big drop ahead of preparation for the holiday shopping season, which we'd think there should be a big increase in demand. At least that's what we've been told by these manufacturing PMIs. U.S. retailers continue to draw from their overstock of inventory that was delivered during the record cargo surge over the past 2 years. So again, we're looking to see signs demand is crashing down. And when consumers don't have access to credit because their credit cards are maxed out and perhaps their energy costs are going up and their rent and food costs, that means they have to cut their spending somewhere. And we noted, looking back last week, that we saw the University of Michigan data started to roll over, and we've been warning on the show saying if consumer confidence flips, if it starts to move to the downside, which we saw in the Conference Board data, we're starting to see in the University of Michigan data, watch out below, because as you see in this chart, there's a huge correlation between consumer confidence and new orders. Here you see the current new orders. This is the Fusion Index from the Philly Fed, one of our favorite data points we like to look at, against the University of Michigan Consumer Sentiment Survey. That's shown in blue, and sure enough, when consumers are more confident, what do you see? New order demand goes up because, hey, when people feel better, they spend. And as we're starting to see now, confidence is rolling over, suggesting that this demand in new orders, which backfeeds into that decline in cargo, it makes perfect sense that consumers are here likely tapped out. The port also saw cargo activity drop 8.6% compared to July 2023, when volumes reached over 725,000 total TEUs compared to pre-pandemic figures. The East Coast port saw volumes fall 3% compared to August 2019. So we're definitely seeing things go down. But one thing that's up, at least, is, according to the Fed, of course, we're going back to July here. U.S. job openings top all forecasts as white-collar positions jump. Now, before you get too far into this report, I want you to understand the JOLTS report is back to July. So it's always old data. But nevertheless, the market reacts to it as if it's fresh, brand new data that's happening right now. And sure enough, that is not the case, as the number of available positions increased to 9.61 million from a revised 8.92 million in July. According to the BLS, hiring edged up while layoffs remained low. But there's a big correlation, and we've shown you this on the show before, between the job openings, or JOLTS, that's shown in blue, and the Wilshire 5000 price index. Now, I want to notably point out that the JOLTS index is still on a downturn, but it doesn't move in a straight line, but it's generally fairly correlated with the equity market. So what we would expect here is there to be a huge surge in job openings, and we haven't really seen that, suggesting that perhaps the optimism in the equity market isn't translating back to the consumers who are looking and still not spending that much. But nevertheless, we see some increase in job openings in July. Of course, that was a good sign. The problem is we're in October now. The pickup in openings reflected more than 500,000 increase of professional and business services. This again, as we look to go into the back-to-school season, as well as more postings in finance and insurance, education, and non-durable goods manufacturing. The rebound in vacancies points to how resilient demand is underpinning staffing needs, while an improvement in workforce participation and consistent wage increases has helped ease worker shortages. But nevertheless, just because there's job openings doesn't mean they translated into job hirings. That's the big difference. People can flag jobs, but ultimately, if demand changes and they don't hire people, it's irrelevant. But nevertheless, that is one of the most favorite of the reports for central bankers to look at. But as we know, it's old, and yet they think it's brand new. But one thing as we head into our lead story today, and we talk about freezing redemptions and why, of course, investors want out and this company wants to keep them in. Well, let's start picking up what's going on in the commercial real estate space, because a severe crash now is looming for commercial real estate office towers, which we've been warning is coming for months, as turmoil lasting years. Of course, it's not going away tomorrow. Banks in the U.S. will lose $250 billion in office over time here. This according to Bass, the founder of Heyman Capital Management, best correctly known for predicting and profiting from the bursting of the subprime housing bubble. He said there's about $2 trillion of equity in the banks. It's like a 10% hit to the banking equity. And of course, we've noted these small and mid-sized regional banks, they hold a ton of commercial real estate. This is one of their bread and butter businesses, and they're insolvent. That's the big problem. We know they are outright insolvent. They can't afford a haircut on these at all. And Bass is saying, look, this is going to be a huge problem. And what's clear is the refinancing won't be pretty for business owners. A Green Street Commercial Property Index shows towers have fallen nearly 16% from the peak in March 2022. Of course, what we're telling you is what they're not going to have a lot of stress, because they're going to hand the keys to the buildings back to the bank and say, you know what, if you don't write these down, you eat the loss. We're not going to do it. And the banks, they can't take any sort of loss at this point, or they will outright fail. Meanwhile, a recent report from Morgan Stanley expects commercial real estate prices to be down 27.4% from the peak to trout in 18 to 24 months in the cycle. That would blow up so many banks we can't even begin to count, and not that far off from the minus 34.9% during the global financial crisis that occurred over 34 months, which will range from a decline of 15% for apartments to a stunning plunge of 40% for office. Now keep in mind, when in the global financial crisis, small and mid-sized regional banks, they weren't insolvent. Now they are, and that's the problem. And you see more evidence. This is all about money going away and drying up. So you're seeing now the experts suggesting, finally, commercial real estate is going to crash. Notably, they don't mention the banks, but now look what we see in the news today. WeWork on the brink of default as 95 million interest payments are skipped. And why would they skip them? Well, they don't have the money. And WeWork skipped interest payments on $95 million on Monday on 5 of its bonds, triggering a 30-day grace period. It comes 2 months after the struggling co-working startup warned, quote, substantial doubts exist about staying in business, and 1 month after WeWork CEO David Tolley said the company will seek to negotiate terms of our landlords for underperforming locations, translating to, we're going to ask them to take less money because we're going to give them the option, either they don't get paid or they take what we're willing to pay. And as such, today we entered the 30-day grace period provided to us under our secured notes indentures and withheld the associated interest payments and noted in a press release. So again, why don't they have the money? Because there isn't enough money being created in the system. You know, that's the problem right now. Commercial industrial lending is now at zero on a year-over-year rate of change. And so we know there isn't now enough new money being created to offset the flow of money being destroyed as payments are being made on these loans. And if we continue to see the trend following, then on net, more money is going to be destroyed, leaving less money for everyone else. You're going to see a continued increase in delinquencies and defaults. There'll be lots of restructuring until the whole system breaks. And here's where we're headed, over to Blackstone now, whose massive CRE REIT records 11 months of outflows. Now you think about it, why do investors want out of this thing? They don't want to get trapped again. As Blackstone has limited investor redemption requests from its $68 billion real estate trust for high net worth investors for the 11th consecutive month, while the Fed pushes interest rates to 2-decade highs, which has only sparked turmoil in regional banks earlier this year and an ongoing commercial real estate crisis. According to a letter obtained by Bloomberg, the Blackstone Real Estate Income Trust recorded investor outflows for September at $2.1 billion. That's a staggering amount of money, 28% less than what was requested withdrawal in August, which is good news. But get this, the fund only returned $625 million, or about 34% what was requested, as the massive real estate trust continues to gate redemptions to prevent outflows. And why would they do this? Why does Blackstone not want money to leave? Because it means they have to sell property, and then they have to sell them at a loss. So they do the only other thing they can do is say, you can't leave, we'll keep your money, we'll give you what we can, but you're going to stay. And investors are panicking. They know that the commercial real estate market is outright going to crash. They don't know what to do other than getting their money out, and it's going to be a problem. You wait until the whole sector goes down. And of course, there's one group of people who just think nothing's going to go wrong, and that's the Fed. Here we can see Bostic says the Fed should hold rates high for a long time. As Atlanta Fed chief says he's not in a hurry to hike rates again. Well, he's going to be in a hurry to cut them pretty soon. He says, I'm not in a hurry to raise, but I'm not in a hurry to reduce either, he said in a recent event at Atlanta. If we reduce too soon or send signals that we are not resolved, we won't get to 2%. And we have to get to 2%. Well, the problem that Bostic doesn't realize here is they're probably going to blow right through that 2% number at some point. Now, I know that's not a popular view. Many people think that inflation is now embedded. We're going to only see higher inflation. But notably, the whole recurring theme of today's show is there isn't enough money to sustain the whole system. And if there's not enough money, well, that means consumers don't have access to it. They can't go and spend. And if they can't spend, the next thing you know, demand crashes and prices, well, they don't go up when that happens. So I want us to hold, he says, I think it's the appropriate thing to do, well, for a long time. And we can afford to be patient, he says, as long as inflation expectations don't move. Our surveys say it's not happening, and that's why I'm willing to be patient. He said, we need to see Fed policy get more restrictive to bring inflation down. I don't think we need to push it that hard. One of the challenges here is we're seeing demand go down, and that's why I wanted to show you all of those stories about the system is running out of money, and the one group of people that says, hey, we're really optimistic here. Things are looking good. In fact, we're going to have to just keep things restrictive for longer because the economy's too hot. Well, they're missing it because they're too fixated on lagging data like the JOLT series instead of the real data that many of you have commented about and we see every day. But one thing we do think is headed a lot higher, and that's the stock of our sponsor today, MyMD. Now, they're developing a groundbreaking therapies to fight chronic diseases, and you can find all their information in the pinned comment and the description below. And they are a clinical stage biopharma company who is developing groundbreaking therapies for the treatment of serious and debilitating autoimmune and inflammatory diseases. Our clinical lead candidate, MyMD1, is an orally available next-generation TNF-alpha inhibitor with the potential to transform the way TNF-alpha-based diseases are treated. And wait till we get to the stock side. One thing I think will transform your trading account is the big setup we're seeing on their stock. They're under the NASDAQ, under the symbol MYMD. Let's continue. With a small molecule design, selective mechanism of action, and the ability to cross blood-brain barrier, MyMD1 has the potential to disrupt the TNF-alpha inhibitor market and provide meaningful therapeutic solutions to patients not served by current therapies. And here we can take a look at their chart setup, and this is beautiful. We teach you about supply zones on the show. We show you how to trade our stock of our sponsors. Let's start down here with the MACD. Positive cross coming out of oversold territory. That's what you want. How about the RSI? Coming out of oversold territory, running around 37. We want to see it break up to 40 to really validate momentum moving higher. But look at this. There was a supply zone above. This is where buyers were at. And all of a sudden, those buyers turned into sellers and drove the price down to where it was at the time of filming, which is right around 58 cents. And you'll notice buyers stepped in here at this level and moved back up into that supply zone above. Well, that's a 100% move. MyMD1 has demonstrated the potential to slow the aging process and extend healthy lifespan. The product is being evaluated in phase 2 studies as a result of the aging process, as well as early stage trials for rheumatoid arthritis with the potential to expand into other applications. A second therapeutic candidate, Supera CBD, is a novel synthetic non-toxic cannabinoid analog that's 8,000 times more potent than a CB2 and agonist activator than a plant-based CBD. In addition to its potential role in managing anxiety, chronic pain, and seizures, Supera CBD has been shown to have anti-inflammatory effects. And then you can see now they have a big announcement. FDA accepts MyMD Pharmaceuticals investigational new drug application for phase 2 study of oral TNF-alpha inhibitor for the MyMD1 and rheumatoid arthritis. We think that could help be the catalyst to taking their stock higher, and why we've seen such accumulation down here. And there's the setup. As you see, seeing the supply zone. Look at the volume profile. That's where the buyers are at. We're going to zoom in a little bit more. You see the sellers up at $1.14. That's roughly your 100% move to the upside. The RSI, as we look at this 90-day chart, 52. You see momentum building. The MACD is starting to build as well. And now let's zoom in. You get a real clear picture of the supply zone. And look at the volume profile line, 52 cents. All we're looking at now is a move between zones because there aren't a lot of sellers there. There's some between around the 95-cent range, a little bit there, but a breakout here. You see no sellers up until you get into roughly $1.15, and that's where we see the big opportunity for MyMD. Symbol again, MYMD on the NASDAQ. As with always, any company we feature on the show, you're under no obligation to purchase their stock. Be sure to do your research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.